Home sales in Vancouver just hit a 6-year low and ultimately reflect the horrific state of consumer confidence in the marketplace, which hit an all-time low just last month. Trump's tariffs are in effect, and that is going to cause quite the quandary over at the Bank of Canada, who they are seeing obviously GDP up, inflation up, housing down, and plenty of debt to refinance. On top of all this, fresh off the presses, we have the brand new March Vancouver real estate data. And we are going to break down what happened with sales volumes and prices and share insights into all the dynamics that are going to affect home prices further and probably for the rest of 2025. Let's dive right in. To really frame up this episode, I think we should look at the state of consumer and business confidence. Both of these metrics have hit an all-time low just last month, which dates back at least 25 years, as long as these metrics have been tracked. This ultimately means that the average Canadian, the average consumer in our country feels worse off today than they did during the depths of the global financial crisis and during the pandemic. Small businesses, well, they feel equally as bad and also the worst on record. And when you think about it, you simply will not see consumers spend money or companies do any form of growth or additional spending or investment when they all feel this poorly towards the outlook of Canada. And keep in mind, these all-time low numbers that were hit happened before the tariffs officially came into effect. This means that people will now ultimately be even less likely to want to spend money, invest in their business, or hire more employees. You just cannot see a world where home sales, for example, are going to increase when people are holding onto their cash and laying off employees. Ultimately, I think it could get very ugly in the months to come.
Yeah, I mean, these tariffs have been a doozy, and I think we're just getting started. With that, let's touch on inflation here. A couple of weeks ago, we saw a surprise inflation print. It came in at 2.6%, and that's a sizable jump because for the previous month, it was sitting at 1.9%, though we were expecting it to increase to hit 2.2%. I think this is due in part to the GST being added back in. That's maybe part of the reason. The other part I'm thinking of is we probably saw some companies front-running purchases ahead of tariffs. With that being said, though, here's some notable points. Within the print was the mortgage interest cost, which dropped for the 18th consecutive month. 2.6% is the highest reading that we've seen in 7 months, and this was not welcome news to the BOC. They're in an increasingly hard position of maintaining inflation while trying to stimulate an economy that's been in a per capita recession for at least the last 2 years. And as of late March, the markets were expecting no rate cuts in the upcoming April 16th meeting. All eyes will be on the March inflation data to determine whether or not we're continuing down this inflationary path or if it was a bit more of a one-off. But what's behind that is the share of businesses expected to raise their prices this year, many expecting to raise more than 5%. In fact, this number has jumped to 45% of businesses. It was barely 22% just 6 months ago, so doubling in a very short period of time. This will understandably contribute to pushing inflation higher, especially in the months to come. So while tariffs may warrant a short-term rate cuts, we'll probably see that come down. Inflation is the inflation rate is likely going to drive up with these inflationary tariffs.
Another element that, of course, the Bank of Canada keeps a close eye on is the GDP. And StatsCan posted Canada's latest GDP numbers just last week, and surprise, surprise, it showed another month of growth, increasing 0.4% in January, which followed an increase of 0.3% in December. Remember, these numbers are not reported on a per capita basis, which, as Ryan just mentioned, has been negative for over 2 years now. Now, according to StatsCan, 13 of the 20 major industries actually expanded from the previous month, which was led by mining and oil and gas extraction. Based on all the other data points we've already discussed on, and essentially all the ones we're about to discuss further, I find GDP being in the positive and growing a very hard stat to believe. But whether you believe it or not, what's important here is that if that is the way and the metric and the data that the Bank of Canada is looking at, is saying, okay, we've got another positive GDP print, and that is the realistic snapshot of our economy, that also points to the likelihood of no rate cut later this month.
Yeah, speaking of rates, let's look at the US Fed. So last month, the US Federal Reserve held its benchmark interest rate of 4.5%, signaling potential cuts later in 2025 despite economic uncertainties fueled by tariffs and slowing growth. The Fed's updated projections now foresee 2 rate cuts throughout the rest of the year, though Chair Jerome Powell has emphasized that elevated rates could persist if inflation doesn't decline at the pace they're looking for. Alongside unchanged rates, the Fed is scaling back its bond runoff program, effectively loosening monetary policy, suggesting a more cautious stance in light of moderating consumer spending and softer job market data. Inflation is now projected at about 2.8%, while GDP growth expectations were downgraded to 1.7%, reinforcing the view that monetary easing may be still required. For Canada, these developments could have significant impacts and likely more good news than bad news. If the Fed moves towards cutting rates, the Bank of Canada will face less pressure to maintain higher rates to defend the Canadian dollar, especially if the U.S. economic momentum continues to slow. With U.S. inflation remaining sticky and growth faltering, the global environment may shift toward more accommodative monetary policy, potentially opening the door for more rate cuts up here in Canada, particularly if Canadian inflation continues to ease and economic risks, including from global trade tensions, persist.
In Canada, there are approximately 1.5 million mortgages that are renewing in the next 12 months. So understandably, many eyes are on what's going to happen with rate cuts, both south of the border and here in Canada, and ultimately how they're going to affect mortgage rates and the projections that are coming by all the economists who are paying attention to this. Ultimately, the question becomes to renew fixed or variable, or potentially a combination therein. We have an update from the top 6 banks in Canada, right? You got to think they all have their economists and they're all providing their projections as to where they think the Bank of Canada may go, and then advice to their banks accordingly. So they've all provided projections all the way up until the end of 2026. And the most optimistic projection comes from the Bank of Montreal, who forecasts a 2% Bank of Canada overnight rate by the end of next year. On the other end of that spectrum is Scotiabank, who forecasts 2.75% by the end of 2025, ultimately meaning that they are stating no cuts between now and 2027. The other banks were somewhere between 2.25% to 2.5%. So while no one knows exactly where rates are going to be in 20 months, the consensus by the big banks is somewhere between no more cuts and a total of 0.75 cuts between now and the end of next year. None of the banks, mind you, are currently projecting any rates that are higher than today. So if you have a variable rate mortgage and you've been riding down the rate so far, and we see 1 or maybe even 2 more cuts, that may very well be the time to move over into a fixed rate mortgage. That is, of course, if timing is your thing, because it does appear that we may not get lower than that for some time. And ultimately, locking in today, you're going to see a rate high 3s, very low 4s. I mean, these are numbers that were only dreams just a few short years ago.
And let's look at housing starts here. So the amount of new homes coming to market is continuing to drop. Across the country, home starts fell by 4% month over month, and starts were down 12% year over year. And it's much worse here in BC as well. Starts fell by 22% from last month in all areas of the province, and are down a whopping 32% below the levels found in February of 2024. And 2024 was not a good year for building. If we look even more localized, Nanaimo is down 60%. Victoria is down 46%, and Vancouver is down 18%. Starts, of course, lag development permits by upwards of 1 to 2 years, and as we report on frequently, new development permits are near zero, meaning you will see the amount of housing starts continue their downward trend. While today's market, this may not seem like too big of an issue because we've got quite a bit of supply floating around, but as the completion cliff continues, with very little new product starting up, the next phase of the housing shortage or the housing supply shortage appears to be starting in about 2028.
So let's expand on this housing shortage and take a holistic view and definitely a 50,000 foot view. Because like Ryan just mentioned there, the current spike in inventory may have people thinking that, yeah, Canada's okay. We have enough homes. Now, of course, it's noticeable that since the all-time peak pricing in 2022, with all these inventory, all these new homes, all these homes that are available on the market, prices in Vancouver have only dropped 6%, which I don't think it's enough to make homes affordable in the eyes of most people. But let's take a real big picture and go all the way back to 1972 and compare housing completions to population growth to get a bit of an understanding of supply and, of course, the pricing dynamics that come with it. You would think the higher the population growth goes, the more homes that would be built, right? Simple supply and demand economics. This would be a fundamental element to keeping prices at least stable, possibly even remain at that 2.5 cost to income ratio that was once realized just a few short decades ago. Unfortunately, the opposite has happened in Canada. If we go back to 1972, the country saw population growth of around 240,000 people. And in the same year, saw 220,000 homes completed, a balanced figure where supply met demand. Now, since that time, population growth has trended upwards in a smoothed out straight line, basically hitting 450,000 by 2022. Housing completions, on the other hand, have trended downwards throughout that entire time frame. 40 years they've trended downwards, starting at 200,000 and now down to 190,000 overall. Now, that's not a significant drop on its own, but dramatically low when you compare it to the rate of population growth, which has doubled over that same period. This is a stark reminder that Canada has been underbuilding for almost half a century. And with population expected to continue back to its around 1.2% annual growth rate, and both housing completions and starts falling dramatically, it doesn't take a genius to see where future problems are likely to be realized. Based on this data, Canada should be completing around 400,000 homes per year just to maintain the status quo. Yet our country has never found a way, ever, to build more than 250,000 homes in a single year. And that number was realized in the 70s and has not ever been trumped or been beaten. We all know that CMHC it forecasts about a 3.5 million shortage of homes by 2030, which is only 5 years away. And yeah, that's not new information, but it's a reminder that there is no sign of a significant solution to Canada's housing shortage anytime soon. And look, when we talk about a housing shortage, to clarify, if what we're building is too expensive for most people and unsuitable for their needs, then yes, I guess that would mean we have a shortage of affordable housing, right? Doesn't matter if we have 100,000 500 square foot condos out there that people don't really want. Are we making attractive, livable, and affordable homes for the Canadians that need them?
I think largely the answer is no. And I also struggle on both sides with both sets of politicians who are promising that you can build more than 250,000 homes when, like you said, historically, it's just, we haven't seen that happen. And speaking of which, I think a lot of them are considering rental units or purpose-built rentals to be that affordable option. Doesn't exactly build wealth for anyone, and payments never end on your home if that's in fact the case. Rental units now, let's jump into them. One area of housing that does not appear to have a shortage is purpose-built rentals. Rentals under construction just posted fresh record of 147,000 units, the equivalent of approximately 6% of the existing rental stock. And BC leads the way with rentals under construction as a share of the total stock at 15%. So you can expect rental rates in this area to continue to drop, but also expect the amount of investors to disappear, meaning existing ones will continue to offload the condos onto the market, and fewer will be buying pre-sales. There's just going to be infinitely more options for people who are going to be renting these units. You can see where all of this is likely heading.
Let's expand on that now and look at what's happening in the Toronto presale market, because they've basically hit what looks to be rock bottom. If you can believe this number, only 400 transactions were recorded in February. That is a 50% drop year over year. And if we zoom out, it gets even more staggering. The 10-year February average for presale units to be sold in Toronto is about 2,570 units, meaning we're down about 84% from what is typical for this time of year. And it isn't just a one-off bad month. It's part of what is definitely looking to be a troubling trend. Sales have hit all-time lows multiple times already at the end of 2024. And in December, wrapped up with the lowest new home sales in 40 years. And yeah, there's just a few more people in the GTA than it was 40 years ago. You can imagine the compounding effect there. So if you've been wondering why people like our new prime minister are sitting with the condo king, Bob Rennie, to discuss ways to stimulate the presale market, it's because of this, right? When sales are so low, they are foreseeing the troubles that are ahead and the knock-on effects and the unemployment spikes that will happen within housing, right? They're also talking about mortgage insured homes being purchased up to 1.5 million, GST being removed, capital gains being scrapped, and of course, a change in tone around those exorbitant development fees. When industry starts to suffer, you see government come in and start to shake things up. And that's exactly what we're witnessing in real time now. The government need to stimulate this part of the industry as they can see all this pain ahead. Ultimately, as we've seen time and time again, the problem is these policy shifts that are being discussed now may be coming a bit too late and might not stop the bleeding in time before the economic mismanagement really kind of rears its ugly head and shows how expensive it is. And guess who gets to pay all of it? The average Canadian.
Okay, let's move into the institutional buyers here. So over the last few years, there's been growing talk and I think growing concern around institutional buyers, namely Wall Street buying up single family homes and more condos, condo blocks, and renting them out. So we wanted to look into this to see how much of an issue it really is. The data, unfortunately, is just for the US that we have right now, though we're expecting similar numbers out of Canada. And ultimately, the number of homes owned by institutional buyers is actually, and surprisingly, quite small. The vast majority of homes are owner-occupied. And the second largest share of owners is what you would call your mom and pop landlords or your mom and pop investors. That is, people who own more than 1 to 9 homes, somewhere in that range. So if the specific concern is that people are out there buying houses and then renting them out, the more viable target is actually these smaller landlords that own multiple properties. But people don't often seem too upset by them. It's more about the big, bad Wall Street guys that are causing further affordability issues. So let's go back to the institutional buyers. The largest buyer was Open Door, which is also called an iBuyer, which clocked in at just under 12,000 homes in 2024. They don't actually want to hold a lot of the homes that they buy. Instead, they buy, renovate, then resell as quickly as possible. The second largest is a group called New Western. They are a wholesaler or a double close buyer. These buyers want to own for an even shorter period of time, and sometimes they never even close or actually own the home, but rather they just assign the contract to a new buyer. What they're trying to do is buy at a discount and then immediately turn around and sell for a profit. And this does arbitrarily move the price up. Even still, what this data suggests is that single-family rental funds aren't as dominant as some might think. The overall counts for all of these largest buyers also remain relatively small. Let's look at last year. There were over 4 million existing homes, including condos and co-ops, were bought and sold in the US. And this was a nearly 30-year low, by the way. Compare that to the 30,000 that institutional buyers bought, and equates to less than 0.008%. It barely registers on the radar. And the majority of those bought to improve the living conditions of the home and then sell on the open market are done for a gain. So you can blame who you want for housing affordability issues. Just know that targeting the institutional buyers, it may be misdirected, at least at today's scale. The price creep is likely more closely linked to expanding money supply and inflation, along with standing inventory.
I get it, right? It's frustrating out there. Homes are very expensive, and people want to blame someone. That's a natural feeling. It's like what we hear locally with house flippers, right? With people who renovate and sell homes, and when they get blamed, and then you understand when you research it how actually small a percentage is that they actually contribute to the marketplace. So, and so while the anger is understandable, yeah, it can be misdirected because again, you have to get all the information before you can really understand what's happening with our home prices. And it's a very systematic and very convoluted and very complex issue.
Well, Dan, even if I may, David Eby just came out and basically did an about face, a 180-degree turn on what he was calling these really, really nasty home flippers and those nasty investors, realizing that, hold on a second here, our marketplace really actually needs them. And it's very interesting. I think after the data settles in, you continue to look at it. Yeah, the data is the data.
Don't want to get ahead of ourselves, but what may even come our way in the next couple of years is when all the people, speculators, have stopped buying pre-sales for a number of years, and then all of a sudden there's no condos coming to market or new homes that are being resold on the open market as brand new product because the speculators couldn't afford to take that risk, and home prices get pushed up because of sheer lack of supply. People may be open to speculators coming back in. But again, that's for you to decide. Let's talk now about what's going on with mortgages, because mortgage originations, which includes new lending, renewals, refinances, they're up a whopping 110% in January, and that's year over year, with what looks to be a lot of room to go. Those who locked in rates 5 years ago and are renewing today, they're facing about a 35% increase in payments upon those renewals. While we're also seeing a wave of mortgages refinance at lower rates, right? There's about 1 million people who have purchased in the last 2 years who can refinance today and receive a lower rate and thereby a lower payment. Of the people who are getting new mortgages today, the majority are definitely choosing to go variable to the tune of about 40% of all new mortgages. 3 to 4 year fixed, those are the second most popular new mortgage type. And do note, there is a new and renewed interest in mortgages overall. Like we're talking people who are buying for the first time, bigger homes, investment properties, and so forth. Where in Q4, we saw $29 billion in new mortgages originate. And that's the largest increase dating back just over 2 years. This may be spurred on by the recent lowering of the house debt service ratio. Canadians are actually improving in this area where we've seen the ratio drop from just over 15% down to 14.4%. Sure, not a huge number, but it is trending downwards, meaning people are starting to be able to afford their debt more than they have for the last few years.
All right, let's move over to household net worth. I think this is going to aggravate some and surprise others. But Canadian household net worth has surged in recent quarters, hitting a record $17.5 trillion. This has almost doubled in just the last 10 years, where in 2015, it was at $9.5 trillion. But Dan, check this out. I dug a little deeper. And what I found to be very interesting is when you look at the M2 money supply, the overall volume of dollars in circulation, 10 years ago, it was at 1.36 trillion Canadian dollars. Today, it's at 2.6 trillion, almost double. And I think there's sort of two things happening here. You've got asset values that are growing far beyond the pace of wage growth. And then you've got purchasing power that is dropping being debased at the same time as more and more volume of money enters the system. So, as we continue down this path, it's going to get harder and harder to stay ahead without having your hard-earned dollars attached to assets just because of the inflationary tendencies that we find ourselves in. In Canadian household net worth, it refers to the total value of assets owned by Canadian households minus all of their liabilities. It represents the overall financial position of households across the country, those who own homes specifically. While this may sound great overall, it's likely more representative of the top 10% becoming even wealthier. And in Canada, the distribution of net worth is notably concentrated among the wealthiest top 10%. In fact, as of 2019, the top 10% of Canadian families held approximately 57% of the country's total net worth. Interestingly, in the US, the top 1% own 31% of the nation's wealth, while the bottom 50% own a mere 2.6%. And this inflection started back in 1971, and the number has grown substantially since COVID and around 2020.
Yeah, with that data being almost 6 years old now, I could imagine, Ryan, that 10% of Canadians holding 57%, I bet that's upwards of, high 60s, even 70% now. There was a massive transfer at that time.
Yep, and it's still going on, Dan. That's the other thing. The other thing that people don't recognize is that increase in money supply that I touched on as well. If you look back over since 1971, or call it 50 years, it was growing or accruing at about 7%. But since 2020, it's gone to above 10%.
Well, we used to talk about record-setting population growth in our country, and I think we've been a little quiet on population lately. So let's do an update here, because the population growth rate is absolutely slowing. Remember when it basically tripled and started to hit upwards of 1.3 million per year? Well, this past year, it slowed to 744,000. That number is still one of the strongest on record, but clearly heading back down in the right direction. The 15-year average, it sits around 420,000 a year, so you get an idea. But when we get even more micro, the population growth rate, it was just about 0.15% last quarter, which was the slowest quarter going back 8 years. Plus, for the first time in 3 years, the non-PR cohort that we talked about a lot during the COVID era, well, that outright shrank. It contracted. So this ideally will start to allow for our pressured infrastructure, which includes our schools, our hospitals, and our housing shortages to catch up and join a more regulated growth rate. So there you have it. That is what has happened within the economics in the last couple of weeks. And now we are going to get into the March Greater Vancouver real estate data. As always, we are starting off with the health of the market, aka how many homes sold last month. Well, it is still on life support. There were barely 2,090 homes sold in the month of March, which was like 13% lower than 2024, which, as we all know, was a very slow year to begin with. And let's go bigger picture here. How does it compare to the 10-year average? 37% lower than the 10-year. So it's incredibly slow here. And this is supposed to be March, right? This is the month. This is our spring market, and it's not. This is the lowest March sales since 2019. So we're talking about a 6-year low here. And that month was 1,731, which I believe was an all-time low. So we're second slowest since then. It's fun to compare Toronto because Toronto is clearly still the epicenter of this major housing swing. Toronto sales were at 20-year low. So they continue to be the most extreme marketplace now. Since the all-time peak year of sales, so in 2021, there were more home sales than any other year historically, we've seen a steady decrease in total home sales year over year over year, just dropping 4 straight years of declines. And right now, there's basically no sign of that turning around, right? Especially with like the level of uncertainty caused by Trump and the tariffs and blah, blah, blah. Like it's not a landscape or marketplace where people are like, yay, I feel confident in housing. Let's go buy some. So as of right now, 2025, people are still absolutely on the sidelines, and you can expect a slow volume sales grind for probably the rest of this year.
And new listings. I mean, my goodness, we're at 6,450 new listings. It's a 29% increase year over year and 16% above the 10-year average. Condo listings, by the way, were the second highest for the month ever recorded, only behind March of 2021.
So understandably, we are seeing inventory levels increase at a dramatic rate. At the end of the month, it washed out at just over 14,000, which is a 38% lift over last year. And then again, big picture, we're currently sitting at 45% above the 10-year average in active home listings. This is an 11-year high for the month of March. And also note that there have been obviously a ton of relists and new listings in the first week of April, as the market does. And right now, there's over 15,300 active listings in Greater Vancouver. So ultimately, I mean, there's lots to choose from, but lots of it are just not great, right? It's like it doesn't matter if we have 15,300 listings if people don't want 15,200 of them, if you know what I mean, if there's just all condos or all old homes, whatever the case may be. Now let's do just a quick update to a national inventory, because the national inventory hit a cycle bottom in 2022 with only 98,000 homes across the country. It's up over 70%. There's 170,000 active listings in Canada today, though do note it's still a fair amount below that 2015 peak, which had 250,000 homes available for Canadians. So starting to get closer now to at least long-term averages.
And didn't total inventory last year peak around 15,300? Wasn't that like right around the top?
As far as like the wash out of the at the end of the month, it's actually recorded. Yes,
Yeah.
that sounds very familiar.
Yeah.
I'll pull it up in real time, but yeah, I think that's it. Like we're definitely going to surpass last year.
Oh yeah, I don't doubt that either. I've just, I remember that at the end of the spring market where it peaked, and then inventory kind of peeled off from there.
Oh, great memory. September 2024, 15,178. So just below where we are active now. But of course, that was the washout at the end. So during the month of September, it could have been upwards of 16.
Wow. There you go. So anyways, moving over here to the sales to active ratio, looking at whether we're in a balanced buyers or sellers marketplace. And surprise, surprise, still sitting in a balanced marketplace, sitting in 15%, up 1% month over month. And this is the 11th month in a row of a balanced marketplace. We are now 10% for detached homes. So that's sitting well within a buyer's market. 23% for townhomes. That's up 3% just into the seller's market territory. And 17% for apartments, which hasn't moved at all and sitting comfortably in a balanced marketplace.
For those of you curious about foreclosure market, it did increase a bit in the month of March. There were 22 additional foreclosures by the end of the month. There's 226 total right now across the entire lower mainland. On a percentage basis, because there's so many active listings now, that ratio actually dropped. But let's go big picture here, or at least bigger picture. We started reporting this back in October of last year, and there's actually less. There's 4 less foreclosures today than there was 5 months ago. So we're basically flat within that metric, no spike up or down in foreclosures right now.
And moving over to days on market here, it actually dropped, though I suspect we're going to see this bounce around, but it dropped by 3 days down to 13 days in total. So if you're priced correctly or priced to market and you've got a desirable home, it should sell within about 2 weeks. And this is the lowest reading we've seen actually since May of 2024. But seeing as global markets lost about $2.5 trillion today, I think we might see this rise.
Okay, we're finishing on a surprise right now, and the surprise is price, because home prices measured by the HPI have gone up every single month of 2025. January, February, March. Every month, prices have increased. We're now up about $19,400 since January 1st, about 1.5% increase. Now, for those of you who watch every week and pay very close attention, you may say, but wait, Dan, we watched last month's stats update and you said HPI dropped by $4,000. Absolutely, I did. So what has changed? Well, very quick story here. Revisions are made within stats, right? I mean, look at StatsCan. They just revised 2 whole years of GDP. Employment numbers are revised all the time. At the real estate board, they do their absolute best to get the data out as early in the month as possible, right? The data for us was out on April 2nd. That's great. But what happens is some homes that have gone firm in the sale are not reported for a few days or even a couple weeks after. And that's just human error, right? Because there's 3 levels here. The realtor has to send the sales data to their brokerage, and the brokerage conveyance office has to send it to the real estate board, and the real estate board has to then post it. So typically, it only takes about 3 days for that data to go from a firm deal to be registered on the MLS. But again, sometimes people are people and they take a little bit longer. Either way, the numbers that don't change are the hard dates and the prices, all that stuff. So we do like to look back and make sure that the data has all ultimately settled, right? So now that it has, that 4K drop ended up being obviously an increase for that month of February, meaning a couple of very late sales in the month were big numbers and pushed things up. So anyway, the reality of today is that, there you have it. 3 months in a row, every month of 2025, home prices in Vancouver have increased. It sounds completely contradictory to everything we're saying, and I am shocked to be here saying it to you. Moving on, let's look at median price up as well, 18,000 to 940K. Average price up as well, 4,000. Average home price now sitting 1,239,000. So all 3 price metrics rose. Ryan, I'm turning this one over to you. Can you help people understand, maybe even myself, how are prices going up when the world is falling apart?
Well, a couple of things. Primarily good homes that have a high degree of utility, that are in good quality and in premium neighborhoods. People will spend their money on those homes because they're going to be in them for a relatively long period of time. And they're typically longer term investments. So we usually see good quality homes sell for a premium, especially in a place like Vancouver that has a number of geographical constraints that other markets just simply don't have. I also think that, maybe in the last little while, you've had a bit more pressure buying before a lot of this tariff stuff and inflations and rates begin to come back up in the back half of the year. Well, who knows? I mean, it's really hard to say. I don't know if the trend is going to continue. That's sort of my piece. It's interesting because I've got buyers and sellers in various different sort of price categories, from, call it, 700 grand all the way up to 5 million, 6 million. And, you think as you've got more budget to spend on a home that you're going to find more and more property that's available to you. But the fact of the matter is, as much like you talked about earlier on, a lot of the inventory we're seeing, it's not selling. And it's because a lot of it isn't great stuff. And so I think until that quality level really starts to improve, especially speaking from a micro market perspective, I think then you'll start to see a bit more traction in terms of volume of sales and price stabilization. But those are kind of my thoughts on it anyhow.
Yeah, you got to think of it like this too. What element of the marketplace has basically disappeared in the last 6 months? The condo investor, right? So the people who are buying those sub 500, 600K condos, they are largely gone. Meaning what's left are the people, as you alluded to, Ryan, that are buying for utility. They're buying family homes. Family homes are $1.2 million here. So you're seeing prices edge up just based on what is being sold, right? And so it's not about volume, right? If the condo investors were here, we'd probably see flat to down prices. But because the price margin of what's attractive to the end user, which is the predominant buyer in today's landscape, we are seeing prices move up. Also, we're in a very volatile market, and I think people who buy in volatile markets are fairly well off and secure and feel comfortable in their positions, right? The amount of cash buyers we've helped just this year, I'd say it's increased, and they're buying at very large price points. So it's secure people and no condo investors that I think are why we are seeing or these HPI prices inch up. So not fully indicative of the market, but again, that's why we provide 3 different price points.
And I think too, that's not to be construed as, pressure or FOMO to buy something, by the way. These are, much like we've talked about, people who have been looking for maybe a year or two. They've been looking for that home for some time. So the last thing I'd say too, Dan, the only other thing that I think will contribute to price creep in markets like this is just overall the rate of inflation. I just think the rate of inflation, when you start taking out volatile items and then start plugging them back in, and we don't really know where those goalposts land, these asset prices will continue to inflate so long as inflation continues to drive upwards and expands. And that's just the other part of it too.
Well said. And there you have it. That is this week's update. Thank you so much for tuning in. If you enjoyed this one, please share it with someone that you think might get some value out of it as well. Have a wonderful weekend, and we will see you here again next week. Bye.